Hello, good day. How are you? I hope you are fine, safe, and healthy. Recall that in my last video, we have learned about the basic concepts and characteristics of forward and futures contracts. This video moves one step further. This video introduces the pricing and valuation of forward and futures contract. In reality, actual price is the price at which counterparties agree to transact, while value is the value of holding a given position. We are going to explore if forward price and futures prices are equal. We are going to answer questions like, what are the key differences between spot price and futures price? At the end of this learning session, it is hoped that students will be able to understand the concepts of forward and futures pricing and calculate forward price, futures price, cost of carry, and basis. Stay tuned and let's learn together. Before we learn about the pricing of forward and futures, let's look into an important question. Are forward prices and futures prices equal? As general guidelines, forward and future prices should be equal when the risk-free rate of interest is constant and when both have the same maturities. However, when interest rates vary unpredictably, as they do in the real world, then forward and futures prices are, in theory, no longer the same. Are forward prices and futures prices equal? With the same question in mind, let's explore the explanation in an example. Unlike forward prices, futures prices fluctuate in an open and competitive market. Futures contracts are marked to the market daily. Let's consider the situation where the price of the underlying asset, S, is strongly positively correlated with interest rates. When S increases, an investor who holds a long futures position makes an immediate gain because of the daily settlement procedure. The gain will be invested at a higher interest rate. When S decreases, an investor who holds a long futures position will experience an immediate loss. The loss will be financed at a lower interest rate. An investor holding a forward contract rather than a futures contract will not be affected in this way by interest rate movements. Thus, it follows that a long futures contract will be more attractive than a similar long forward contract. Based on this attractiveness, futures prices will tend to be higher than forward prices. On the other hand, when S is strongly negatively correlated with interest rates, a similar argument shows that forward prices will tend to be higher than futures prices. In short term, the theoretical differences between forward and future prices are small and negligible. However, as the life of a futures contract increases, the higher the differences between forward and futures prices. Note that there are a number of factors that may cause forward and futures prices to be different. For example, taxes, transaction costs, margin requirements, credit risk, and liquidity risks. Next, we shall learn about the pricing of forward contracts and examine how the value of a forward contract is related to the spot price of the underlying asset, delivery price, interest rate, and time to maturity. Forward contracts are easier to analyze than futures contracts because there is no daily settlement, only a single payment at maturity. The forward price and futures price of an asset are usually very close when the maturities of the two contracts are the same. Learning how to price forward contract is a good starting point because it means that results obtained for forwards are usually also true for futures. This formula considers the value of a long forward contract at time t. We assume that the underlying asset has no income. We see that the determinants of forward value are the underlying asset price on the valuation date, S, the delivery price in the forward contract, K, the risk-free interest rate on the valuation date, R, the time to expiration, T. The value of a forward contract is the difference between the value of the underlying asset at time t and the present value of delivery price discounted as risk-free rate of interest with continuous compounding. Let's apply how to price a forward contracts using an example. Happy trying! Next, we are going to learn the meaning of spot price and futures price and the relationship between them. What is spot price? The spot price of an asset is the current price of the asset. This means today's price. What is futures price? The futures price is the price that has been agreed on the futures contract for the goods to be delivered at the time of delivery. The futures price is simply the price agreed in the contract between two parties at the point of trade to buy or sell the asset at some point in the future. It does not change when the contract has been agreed. Market conditions can clearly change afterwards, but the futures price specified in the contract is fixed once the contract details have been agreed. Futures price are derived from the spot price of the underlying assets. We are going to learn further. How is futures price determined? The fair futures price is equal to the current spot price plus the cost of carry. In the formula, F stands for futures price, S is the spot price, R is the interest rate, D represents dividend, and T is time to maturity. The first formula calculates the fair futures price based on simple compounding, while the second formula calculates the fair futures price based on continuous compounding. Why is interest rate added to the futures price? Well, if you buy futures, you don't need to pay upfront, so you earn interest on the purchase price. The interest rate is usually expressed with continuous compounding. Why is dividend deducted from the interest rate? If you buy futures, you will not receive any interest or dividend that is paid on the underlying assets. Take note that the futures price also depends on the time to maturity, expressed in years. Let's try an example. Calculate the futures price of a stock index, assuming the time to maturity is 1 year. The answer is here is another example on bond. Please try and practice how to get the answer. Let's reiterate what we have learned about spot prices and future prices so far. We have learned about the definition of both prices. The spot price of an underlying is the prevailing cash price in the market. The futures price represents the market opinion of the spot price on some future dates. We have also learned about how futures prices are related to spot price. Futures prices reflect the price of the underlying assets. How is the relationship between future prices and spot prices? While future prices are highly correlated with the prices of the underlying asset during the life of the futures contract, that correlation is not perfect until delivery. We shall learn further. Next, we are going to learn a concept known as basis. What is a basis? The difference between the futures price and the spot price of an underlying at any given time is called the basis. Basis is equal to the price of futures contract minus the spot price. Let's have a quick quiz. If the spot price is the same as the futures price, basis is equal to? What is your answer? The answer is 0. Basis reflects the carrying cost. What is carrying cost? Carrying costs are the cost of holding inventory in stock. For example, insurance, storage costs, warehouse, employee costs, depreciation, cost of replacing perishable items, opportunity costs, and cost of capital. So far, we have learned how to calculate the fair futures price using the following formula. Recall that basis reflects the cost of carry, and basis is the difference between futures price and spot price. When we rearrange the first formula, we shall obtain the formula for basis. This equation is also known as the theoretical or carry basis. Basis will be positive if the cost of carry is positive and negative otherwise. The actual basis, also known as gross basis, can be divided into two types: theoretical basis and value basis. Theoretical basis represents the carrying cost. Value basis is the difference between the actual futures price and the fair futures price. The value basis measures the degree of under or overvaluation of the actual futures price. Let me ask you a question. Which is higher, spot price or futures price? Well, both situations can happen in the real world. If the futures price exceeds the spot price, the basis is positive. This situation is known as Contango. The futures price tends to fall over time towards the spot price, equaling the spot price on the delivery date, at which time the basis is 0. On the other hand, if the futures price is less than the spot price, the basis is negative. This situation is known as backwardation. The futures price tends to rise over time towards the spot price, equaling the spot price on the delivery date. So, again, the basis is 0 at delivery. Next, I hope you can understand how arbitrage activities happen in the futures market to bring the futures price equal to the spot price on the delivery date. Speculators will always buy low and sell high to make a profit. If the futures price is higher than the spot price, as in the case of Contango, speculators will sell the overvalued futures contract and buy the undervalued cash market goods at the same time in order to make arbitrage profit. On the other hand, if the futures price is lower than the spot price, as in the case of backwardation, Speculators will buy the undervalued futures contract and sell the overvalued cash market goods at the same time in order to make arbitrage profits. Hedgers will take positions on the futures contract depending whether they are long or short the underlying cash market goods. Hedgers act based on their expectation about the spot price. Finally, we have come to the end of this video. I hope you have learned some knowledge from this video. If you like this video, please click like, share or subscribe to my YouTube channel. Thank you. See you and goodbye.